November 28, 2008, Iceland's banking system had reached 923% of its own gross domestic product. Not a metaphor, a ratio. 3 private banks were about to fail, and the state let them. On that date, Iceland imposed a capital control regime that legally sealed the krona inside its own borders. Foreign creditors would eat the loss. The domestic economy would keep running. That is the entire mechanism. Everything else is detail. To understand why a country of 320,000 people ended up owning a banking sector 10 times the size of its economy, you have to go back to 2001. That year, Iceland began privatizing Landsbanki, Kaupthing, and Glitnir, its 3 major banks. The government sold controlling stakes to private investors, mostly domestic holding companies with foreign ambitions. By 2003, all 3 banks were fully in private hands. What followed was not organic growth. It was a currency arbitrage machine. The krona carried unusually high interest rates relative to the euro and the yen. International investors noticed. They began borrowing in low-yield currencies and parking the proceeds in krona-denominated assets. The so-called carry trade. Capital poured in. The krona appreciated. Icelandic banks, now flush with cheap access to global funding markets, expanded abroad at a pace no domestic regulator was built to supervise. Landsbanki launched Icesave, an online savings product, targeting retail depositors in the United Kingdom and the Netherlands, offering interest rates well above what local banks could match. Billions of pounds and euros flowed into Icesave accounts. None of that money was insured by a reserve system built for an economy this size. By 2007, the 3 banks held combined assets exceeding 14 times Iceland's gross domestic product on some measures, later stabilizing near the 923% figure by the time the crisis hit. The krona had been propped up by hot money. When the global credit market seized in September 2008, that hot money reversed. The krona began to collapse. Confidence in Icelandic banks evaporated within weeks. Depositors in London and Amsterdam tried to withdraw from Icesave. They could not. The banks were insolvent, and Iceland's central bank did not have reserves anywhere close to covering foreign liabilities. This was not a liquidity problem. It was a structural mismatch between the size of a nation and the size of the financial system it had allowed to grow inside it. Here is the exact legal move. In October 2008, the Icelandic Parliament passed the Emergency Act. This law authorized the Financial Supervisory Authority to split each failing bank into 2 separate entities. The good bank retained domestic deposits, domestic loans, and continued operating inside Iceland, backstopped by the state. The bad bank retained the foreign creditor claims, the Icesave liabilities, the wholesale funding, the offshore debt, and was allowed to fail, entering into insolvency proceedings with no state guarantee behind it. Domestic depositors were made whole. Foreign creditors were left holding claims against a shell. Then, on November the 28th, 2008, Iceland layered capital controls on top of that split. The controls froze the krona inside the country. Offshore krona holders, foreign investors sitting on assets from the earlier carry trade, could not convert their holdings back into euros or dollars and exit. Domestic capital could not flee either. The currency was sealed. This was only possible because Iceland controlled its own currency and stood outside the Eurozone. A country using the euro cannot split its banks this way without European Central Bank and European Commission involvement, and it cannot unilaterally freeze the currency because the currency is not its own to freeze. Greece, Ireland, Portugal, Spain, the group later shorthanded as the PIIGs, did not have this option. They were structurally locked into the euro, and any bank failure inside those countries became a currency union problem, not a sovereign one. Iceland's exit option, its own currency, its own central bank, its own legal jurisdiction, was the single precondition that made this maneuver executable, not policy preference, not political will. Currency sovereignty. The second-order effects followed almost immediately. The krona devalued by roughly 50% against the euro within months. That devaluation, brutal for anyone holding krona-denominated debt, was rocket fuel for anyone selling in foreign currency. Fishing exports, aluminum smelting, Iceland's two industrial anchors, became suddenly dramatically cheaper on the world market. Tourism, still a minor sector at the time, began attracting foreign visitors, paying in euros and dollars against a currency worth half of what it had been a year earlier. Domestic debt, priced in krona, was effectively inflated away for the state, even as it crushed households holding foreign currency loans. Foreign creditors, meanwhile, were forced into haircuts exceeding 75 cents on the dollar in many cases. The International Monetary Fund arrived with a $2.1 billion program in November 2008. It is tempting to describe this as the rescue. It was not. The IMF program was scaffolding around a wall Iceland had already built with the Emergency Act and the capital controls. The wall came first. The IMF money stabilized the perimeter. Someone has to pay for a maneuver like this, and Iceland did not hide who that was. British and Dutch retail depositors, ordinary savers who had put money into Icesave accounts chasing higher interest rates, took the initial loss when Landsbankie's foreign operations were shut out of the good bank. The United Kingdom and the Netherlands compensated their own depositors directly, then turned to Iceland demanding repayment. What followed was a 6-year legal war, culminating at the European Free Trade Association Court. In January 2013, the EFTA Court ruled in Iceland's favor, finding that Iceland was not obligated to guarantee the Icesave deposits under the terms of the relevant directive. The foreign depositors' governments, not Icelandic taxpayers, absorbed the compensation cost. Inside Iceland, the bill looked different. Households holding krona-indexed and foreign currency-indexed mortgages watched their debt balloon as the currency collapsed and inflation spiked past 18% in early 2009. Iceland ring-fenced foreign capital outside its system, while domestic households absorbed years of high inflation, wage stagnation, and a mortgage crisis that required its own separate debt relief program years later. There is no version of this story where nobody pays. The foreign depositor and the Icelandic mortgage holder split the cost between them. The capital controls remained in place for 8 years, not 8 months. 8 years. Between 2015 and 2017, Iceland unwound them through a structured mechanism sometimes called the exit tax, a series of auctions forcing offshore krona holders, the investors still trapped from the original carry trade collapse, to accept a discounted one-time settlement in order to convert their frozen holdings and leave the system. It was not a negotiation. It was a controlled exit priced by the state. By 2016, Iceland's gross domestic product growth had outpaced the broader Eurozone recovery curve. Tourism had become the new engine. Arrivals climbing into the millions annually against a population still under 350,000. That is a new fragility. A banking sector built on foreign hot money was replaced by a tourism sector built on foreign visitor flows. Different mechanism, similar dependency on external demand, nobody in Reykjavik fully controls. Here is the part that does not resolve. This entire maneuver, splitting the banks, freezing the currency, forcing foreign losses, devaluing your way back to competitiveness, only works if you hold your own currency and are willing to impose losses on foreign capital without permission from anyone else. Any economy inside a currency union or without full control of its own monetary policy cannot run this playbook. It can only imitate the language of it. The wall Iceland built was made of sovereign currency. Nobody borrows that.